On Point with Craig's Investment Partners.
All right, good morning all. Remember, as always, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. And for more about our services in that regard, you can go to our website, which is craigsip.com. All right, let's look back at last week. It was another strong one for the US market. The S&P 500 in the US posted its fourth consecutive weekly gain. It rose 0.4% for the week, so that sees it up 12.0% this year and 20.2% above the October lows. So the US market is at the highest levels we've seen since August last year. So those that have held their nerve and have resisted the temptation to panic and sell everything sort of through this last 12 months, or many people have even continued to buy or continued to drip feed into a savings or investment scheme of some sort. You've done pretty well because it's been a healthy rebound. The US market is still not quite back at where it got to in late 2021, although it has recovered much of those losses. So it's been a very strong performer of late, and last week that strength continued. Other markets around the world didn't fare quite so well. Most of them were slightly weaker. The European market was down 0.5%. UK shares were off 0.6%. The Australian ASX 200 slipped about 0.33%. And the NZX 50 declined 1.6%, which is a chunky fall, although it was dragged lower by a few individual stocks. We had some good performers. Serco was up more than 13%. Synlait rebounded strongly, up more than 9%. Vista Group had a good week. It was up 6.5%. But Pacific Edge was belted. The shares fell almost 80% last week after the company released a statement saying that its Medicare coverage would cease, and that, in short, means that they will potentially lose about 75 to 80% of their revenue from next month. So, look, a major blow for that business, and the share price reacted accordingly. That's not one of the bigger companies on our market or in the NZX 50, but it's still part of that NZX 50 index, so it's still to drag things down a long way. EBOS also had a tough week. It was the second worst performer of the week, just behind Pacific Edge. EBOS shares were down 13.5%, and that was because they lost the Chemist Warehouse contract, which is a key contract for them. I think it's about worth about $2 billion a year in revenue, which is sort of almost a fifth of their total revenue. They lost that contract to a competitor, Sigma. Not immediately, but they will lose it from July next year. So that had a bigger impact on the local market, because that's obviously a much bigger company, and it is much more widely held, and it's one of the heavyweights of the local market, and it's been a fantastic performer for many years. So it's a real favourite of investors. If you want research on either of those companies, just get in touch with your Craig's advisor. We've obviously got analysts that do deep dive research on many stocks, including those two, and we've got hot off the press reports that will talk about what's happened there, what it means for earnings forecast, dividends forecast, what it means for our valuation, and we'll obviously have a recommendation about whether there's an opportunity there to buy those, or whether you should ditch them, or whether you should just hold fire, or it often depends. But plenty of material on those individual companies if you want to know more about those two negative announcements and what they might mean. So just touch base with your advisor. So that was share markets last week. Turning to interest rate markets, interest rates are up slightly everywhere. In the US, we had the 2 year Treasury yield rise from 4.5 to 4.6. The 10-year yield was up from 3.7 to uh, a little more than 3.7, not quite 3.8, so up only slightly, but still up. Local interest rates pushed a little bit higher. Our 5-year swap rate increased slightly from 4.4 to 4.6, so bonds did give back a little bit of their recent gains on the back of that, but the NZX corporate bond index still up healthily this year. Is that a word? Healthily. It's up 3.1% so far in 2023. So it's actually performed better than the local share market, which is up just shy of 2%. Currencies, the Kiwi dollar was up against the US dollar and the euro. It was flat against the British pound and it fell back against the Aussie dollar. So the Aussie dollar continues to be quite strong. It strengthened the previous week as well. That came on the back of stronger inflation figures than people were expecting. And last week we had another interest rate hike from the Reserve Bank of Australia, and the tone that they took caused markets to price in further interest rate hikes. So I think that is just providing the Aussie dollar a bit of support, which is a good thing from a New Zealand perspective, because they're a big trading partner of ours. So if we're a little bit weaker against their currency, that's good from that perspective. And for New Zealand investors who own Australian shares, and there's lots of great businesses across the Aussie market that are well owned by New Zealand investors, whether it's the banks, whether it's BHP and Rio, CSL, Ramsay Healthcare, Transurban, APA Group, Woolworths, Wesfarmers, all of those household names, all of those stocks will have performed better in a New Zealand dollar sense with the currency having moved our way. So that was interesting. If we look back at some of the key releases, and there wasn't many, to be honest. Last week was a bit of a quiet one, which was actually a good thing, because we had a few really important announcements sort of in the lead up. So from an economic perspective, it was a bit of a quiet one, although there's always something else that comes up and fills the gap. And last week it was Pacific Edge and EBOS, and probably Infratil worth a mention. It wasn't all bad on the local market. Infratil announced that they would buy the other half of One New Zealand, which is the old Vodafone, and that's a really positive announcement. Well, I think it is. I think Infratil's well positioned, doing some really interesting things, and it is attacking all the right areas in terms of sort of digital infrastructure and so forth. So it wasn't all bad on the local market. We got those two negative announcements that were very high profile, but we also had some good news from Infratil that was much more growth focused rather than something that will detract from their financial performance. Anyway, economic events. Locally, we had another dairy auction and prices were down a little bit further. So more of the same, really. We've seen the headline GDT index slip about 5.5% this year. It's about 25% below where it was last year. We've seen Fonterra reduce its forecast payout for the 22-23 season a few times now. So that's sort of ended up at 8.20. That's probably pretty close to where the final one will be. And in terms of the new season that's just started, Fonterra's at $8 in terms of a midpoint for their forecast, but it's early days, so that'll change. It could end up lower, it could end up higher. Not bad. I mean, I mentioned this last week, but I'll sort of say the same thing again. $8 not bad in the context of history, although it is down from last year and the year before that. And we've also got to remember that costs are up. So, $8 is not what it used to be in terms of a payout to our farming sector. So that was last week. And we also had the Reserve Bank of Australia that I mentioned. They raised their policy rate again, another 25 basis points. That takes it to 4.1, which is the highest since 2012. They're starting to push towards the peak that they reached back during that period in 2011. They got as high as 475. So that was priced in to the tune of about 50%. So that's why you saw a market reaction, because it was, markets were hedging their bets. Will they do nothing, or will they hike? They ended up hiking, so you did see a partial market reaction on the back of that. Now everyone's focusing on the future and how much further do they go. They meet once a month, much more often than the Federal Reserve or our Reserve Bank. So because they meet once a month, they do have the luxury of, more decisions throughout a year. So the next one being early July. Obviously, at the moment, people think that they will probably pause, although things could change. So a pause is expected next month, although current pricing suggests that there's still one or even two rate hikes to come. So if they're at 410 now, another 25 would take them to 4.35. Two more 25s would take them to 4.6. So markets are sort of divided, but they see them ending up in that sort of zone. The April Consumer Price Index a fortnight ago came in hotter than expected, and that could have been a catalyst for the Reserve Bank feeling that they needed to move a little more aggressively than they might have thought before. So we'll be watching those monthly inflation releases because that would have an impact, one would think, on the path of monetary policy. So the RBA was in the spotlight. Actually, the Bank of Canada as well, and I forget where their policy rate went to, but they raised interest rates, and that sort of came out of left field a little bit too. So we had two examples last week of central banks hiking interest rates where markets weren't entirely sure that would happen, and that has just put that's put the idea in people's head that, look, maybe there is a bit more to come. Inflation has been a bit more persistent than hoped and expected, so we know the central banks are getting close to the top. We know we're approaching that point where they're finished and they will pause. But those two examples just remind us that you never know, and that's important for us here in New Zealand as well. We think that our Reserve Bank has probably finished tightening monetary policy, so the OCR is probably at its peak for this cycle at 5.5%, but they will meet again next month, and we'll see what they come up with. I think we're in a little bit of a different situation to others, particularly the likes of Australia. Remember that we started increasing the OCR much earlier than most others. We hiked the OCR for the first time in October 2021, and most of these other central banks, the US, the Europeans, the Australians, they didn't really make a move at all until the first quarter of 2022. The Aussies, I think, were actually even a little bit later than that. It might have been May. So they've got a bit more catch up to play, whereas at least we got a few under our belt in late 2021, early 2022. Anyway, looking ahead, and speaking of central banks, there's plenty on the calendar in that regard this week too. We've got the Federal Reserve, the European Central Bank, and the Bank of Japan all making monetary policy decisions. So this is another reason that those two announcements from last week are so important, because we're looking ahead to this week, and the Fed is the one that's really in the spotlight. The world's biggest economy, the world's biggest central bank, the most influential. The outcome of their 2-day meeting will be closely watched by financial markets, and we will get the result at 6 a.m. on Thursday morning. And that, as always, will be followed by a press conference from Jerome Powell, the Fed chair, and that's where you'll learn a lot more. So that's very much the focal point of this week, Thursday, 6 a.m. At the moment, markets see no change. So they're at 5.25%. Just behind our OCR, and they've moved very aggressively in the last 12 or 14 months, and we think they're pretty close to having done enough, but we're not sure. If I had to put money on it today, then I would say you won't get a change, but certainly wouldn't bet the farm, because you never know what could happen. Pricing is 70-30 in favour of no change. So there's a 30% chance priced in of a 25 basis point hike, but a 70% chance priced in of no change at this meeting. However, when we look ahead, there is still close to one more hike priced in if you go out sort of to the July meeting or even beyond. So because of that, the commentary will be as important as what they do, even if they do nothing. We'll be watching the commentary to sort of try and get a handle on, well, does that mean you're going to do nothing from here, or is this just a pause and then you might carry on later? The summary of economic projections that they release will be important. That is their sort of forecast set, where they forecast where they see the economy going, where they see unemployment, where they see inflation, what they suggests they will have to do with the Fed funds rate. So that's really important. We last had one of those in March. So what's that? 3 months ago, and a lot's changed in 3 months. 3 months a long time in financial markets. So we'll be very interested to see what that new SEP looks like. We've also got the ECB and the BOJ. So the ECB in Europe meets overnight on Thursday, so that'll come after the Fed. Almost certain that they'll hike again. They are at 3.25 for their policy rate, and they were a late starter. They still had a negative interest rate in place this time last year. Still had negative interest rates, so they've moved aggressively since then, but they are a little bit behind the eight ball. So another move is expected, probably 25 basis points. That'll take them to 3.5%, and that will be the highest we've seen since 2001. So you've got to go a long way back to a time when the ECB had interest rates as high as they're expected to move to by the end of the coming week. And beyond that, there's probably another one to go as well. I think at the moment people are expecting the ECB policy rate to peak at around 3.75%, which is high for them, but it wouldn't be as high as the Fed. 5.25%, 5.5%. New Zealand 5.5%. The Aussies 4.6ish. So yeah, that's the ECB Thursday night, and then the Bank of Japan on Friday. Yeah, Friday afternoon. No change expected there. They're obviously still have very low inflation compared to others, and the central bank is still, very reluctant to tighten monetary policy in the way that other central banks have, and they haven't got as much reason to. So big week for central banks. Fed 6 a.m. Thursday, ECB overnight that night, Bank of Japan early afternoon on Friday, and that's probably the order of relevance to financial markets. The Fed is absolutely the biggest and most important one. Sticking with the US, and this is really interesting timing, a day before that Fed decision, we will get the latest consumer price index figures in the US, the CPI, the inflation report. And this will cover May. Should be good news. Not all good news, but mostly good news. Markets are expecting a monthly increase of 0.2% at the headline level, which would see the annual inflation rate slow to 4.1%, which is the lowest. Well, it would be the lowest since March 2021, more than 2 years ago, and well down from 9.1%, which was last June. That's where the headline CPI, annual CPI got to, and that was a 41-year high, the highest since 1981. So that'd be good, 4.1%, lowest since more than 2 years ago. The core CPI, which excludes food and energy, they're very volatile. So, if you exclude them, you get the core measure. Not quite as good. That's expected to have still increased 0.4%. So it's still going up at quite a rapid pace. That would still see the core inflation rate slip to 5.2%, but 5.2 is a lot higher than 4.1. Again, that's below where the core inflation rate got to last year. It got as high as 6.6. It'd still be the lowest since November 2021, but it's that core inflation that is proving a bit more persistent. So that will be interesting to watch. It won't necessarily impact the outcome of the Fed decision. They've probably already, by that point, will have an idea of what they intend to do and why. But it could shift expectations for what people are expecting over the balance of the year from the Fed. What else we got in the US? Retail sales for May in the latest NFIB survey, which is a small business optimism survey. So lots coming out, both in terms of central banks and economic indicators. A bit closer to home, We'll get the Chinese monthly indicators, fixed asset investment, industrial production, retail sales, just some of those monthly activity indicators. They're out on Thursday afternoon. China's been a little bit mixed of late. It has rebounded from a weak 2022, but it's been a pretty fragile recovery, a bit of an uneven recovery. And the PMIs, the purchasing managers indices, haven't been fantastic. Actually, services has been pretty good, but manufacturing has been a bit sluggish, and we haven't seen the strong snapback that we would have expected. So we'll be watching those monthly indicators to see what they tell us about the Chinese economy. Here in New Zealand, we've got the housing market report from the REINZ on Wednesday. This will cover May. Look, the housing market's subdued, but it does feel like things are starting to get to a point of stabilisation, and maybe even a turning point where you might see a bit of an improvement in house prices. Prices have fallen a long way, down 17.6% from the peak. They're still high compared to historic levels because they went up so much in 2020 and 2021, but it's still been a chunky fall. Really hard to predict the path of house prices. They could drift a little bit lower before stabilising, but I definitely get the feeling that turning point is either upon us or close to upon us. So that'd be a good thing, I think, from an economic perspective, because for most people, your house is your biggest asset, and when you see its value falling, it's quite, it changes your behaviour. It's sort of that wealth effect in reverse. You tend to be sort of a little bit more cautious, a little bit more pessimistic. We don't necessarily need house prices to rocket away on us again. In fact, we don't want that. But if they just simply stopped falling, then I think that would at least give people a little bit more confidence, and it would improve sentiment. So we'll be watching for some signs of us reaching that turning point in the market on Wednesday. And then the big one here is the March quarter GDP report, and this will be out on Thursday, 10:45. So this will cover the March 2023. So look, we're sitting here in June, and we're going to be focusing on a report that covers January, February, March of this year. So on the one hand, it's old news; it's well behind us. But on the other hand, it always gets headlines. It will be interesting for a couple of reasons. The first one being that in the December quarter, last quarter of 2022, GDP fell 0.6%, which is a big fall. That was below market expectations. It was the weakest since the middle of 2021, when we were recovering from COVID. And that surprised people by just how weak it was. So you've had that one quarter of contraction. If you get a second quarter of contraction, then that's technically a recession under that definition that a lot of people sort of use, 2 consecutive quarters of contraction. So it could be close. The Reserve Bank, I think, is expecting the economy to grow by 0.3% in the March quarter. So they don't see us in recession at the moment, but geez, 0.3, it's not a lot. I know a couple of the banks have got lower numbers than that. So it's within that sort of margin of error, forecasting error. So it's not unforeseeable that we actually have another quarter of contraction, which would mean we're in a mild recession, and that'd be interesting. That'd definitely make some headlines. There'll be some swings and roundabouts. I imagine, over that March quarter, you had all the bad weather, you had the cyclone, you had the flooding, Hawke's Bay, places like that, parts of Auckland. So all of that will be a clear negative for economic activity, all the disruption and sort of the lost productivity and so forth. Then again, this year we've had much stronger migration than everybody expected. So, a few positives and negatives there. It could be a little bit of a noisy report, but that'll be fascinating to see what that headline number brings. Across the Tasman, probably be a little bit quieter. Markets will be closed on Monday. We had our King's birthday public holiday last week. they've got theirs this week. So the Aussie market closed on Monday. That'll mean the New Zealand share market is a little bit quieter than usual because all of our Australian friends, investors, fund managers, financial market participants won't be in the mix. They'll be off on holiday somewhere. So be a little bit of a quieter start to the week for us too. On the corporate calendar, there's not a whole lot. The only thing I've got on my list for New Zealand is an AGM from New Zealand King Salmon, which is a relatively small company that's probably not on the radar of most investors, but for what it's worth, that's coming. Pretty quiet as well on the international earnings front. The only result or release of note is an earnings release from Adobe, which will be interesting on Thursday. So that's something we'll be watching too. But there you have it, another exciting week coming up. The Federal Reserve will absolutely be the key event, and as much as we're interested in seeing whether they move or don't move, and I suspect it's probably a don't move, it'll be those new projections that are of a lot of interest, and some of the commentary within the release and within the dot plot, which is sort of the survey of participants and where they see things going, and in the press conference. So, we kind of want to get a feel for, how much support is there amongst the Fed for further tightening, and, what are their views on the potential timing of rate cuts? Do they think those are a long way away, or are they open-minded about rate cuts should inflation continue to slow? Or should the US economy slow quicker than expected, or potentially fall into a recession or a slump of some magnitude? So, that's the big one on Thursday morning, and then it'll be later on Thursday morning, mid-morning, where we'll get the GDP report here, and we'll find out whether we're in a recession or whether we aren't. So, thanks for listening, everybody. Enjoy your week, and we'll talk again soon.
For more insights, visit craigsip.com.